Buy-side and sell-side liquidity are at the core of how price truly moves in the financial markets. In today's lesson, we are going to break down how these liquidity pools are created, where they form on the chart, and how smart money uses them to execute large positions and drive market direction. Hello trader, and welcome to the ComLucro channel. By the end of this video, you will clearly understand how buy-side and sell-side liquidity form around equal highs, equal lows, and swing points, why stop losses become fuel for institutional moves, and how to identify liquidity sweeps before the real expansion begins. We will connect psychology, structure, and execution so you can read liquidity with clarity and apply it with confidence in your trading. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Before we define buy-side and sell-side liquidity, we must first understand why liquidity exists in the first place and how large institutions use it to execute their positions. Imagine that major financial institutions, often referred to as smart money, are interested in purchasing a currency pair. To do this, they require a significant number of sellers and corresponding sell orders in the market. This is essential because without available sellers, no transactions can take place. Therefore, smart money needs to trigger the stop-loss orders already present in the market to execute their buy or sell positions. It is often speculated that smart money may manipulate the market, creating scenarios that deceive traders into believing they have a clear understanding of price action. This situation can create an illusion among retail traders, making them believe they are trading on the right side of the market. However, contrary to their expectations, the market moves in the direction of their stop-loss levels, and after triggering these stops, it resumes its normal trend. To thrive and succeed as a profitable trader, identifying liquidity on the chart is essential. These areas where significant volumes of orders are present provide valuable insights into market dynamics and help prevent substantial losses. Liquidity can be classified into two types: static liquidity and dynamic liquidity. Let's briefly explain both. Dynamic liquidity refers to the factors that influence market direction and movement. In simpler terms, it represents the elements that drive market movements, while dynamic liquidity explains what drives movement. Static liquidity shows us where orders are resting on the chart, and it is inside these resting pools that buy-side and sell-side liquidity are formed. To understand this behavior more deeply, let's explore the psychology behind liquidity zones. When price enters an accumulation or distribution phase, it often forms equal highs and equal lows before beginning the next major move, the markup or markdown phase. In these phases, we see a support level at the bottom and a resistance level at the top. Retail traders typically look to buy when the price reaches the support level, placing their stop losses just below it. This creates a substantial liquidity pool beneath the support level, consisting of the stop losses of these buyers ready to be triggered by the market. Additionally, it includes sell stops from retail traders who plan to sell if the price breaks below the support level, believing that such a break will initiate the markdown phase. On the buy side, when we encounter a resistance level at the top of the equal highs, many retail traders look to sell as the price reaches this resistance, setting their stop losses above it. We also see buy stop orders from retail traders expecting the price to continue rising if it breaks through the resistance. This scenario creates a well-defined liquidity pool with various types of orders ready to be swept by the market, both above the equal highs and below the equal lows. Therefore, we have buy-side liquidity at the top of the phase and sell-side liquidity at the bottom. In essence, these concepts represent the same idea, but in opposite directions. Buy-side liquidity refers to areas in the chart where there is a concentration of stop-loss orders, as well as the potential buy-stop orders from long retail traders who operate on breakouts. Sell-side liquidity, conversely, refers to areas in the chart where there is a concentration of stop-loss orders, as well as the potential sell-stop orders from short retail traders who operate on breakouts. Next, we'll examine how the market responds when it encounters these liquidity zones. Suppose the price is moving towards equal highs, and retail traders start selling as it nears the resistance, placing their stop losses above it. If the price pushes upward and breaks through the resistance, it triggers the stop losses of those who entered short positions, generating significant buying pressure as these short positions are covered. Additionally, it activates the buy stops of traders entering long positions post-breakout. This combined buying pressure leads to a surge and creates inefficiencies at the top of the structure, potentially encouraging more traders to open long positions in response to the increased market momentum. These scenarios can occur in both accumulation and distribution phases. The only difference is the direction the market ultimately follows. What truly matters is understanding that liquidity must be taken before the next expansion begins. Smart money does not move price randomly. Its objective is to access liquidity, and that liquidity sits where retail traders place their stop losses. That is why the market often sweeps those stops before making a meaningful move. If price approaches a key level without clearing liquidity first, that level frequently becomes the fuel for the next expansion. Liquidity must be collected before price can continue. Now, to understand this more clearly, let's consider a scenario where smart money aims to execute a large sell order. As the price moves upward toward buy-side liquidity, it breaks through the resistance level. This triggers the stop losses of retail traders who were short near resistance, forcing them to buy to cover their positions. At the same time, it activates buy stop orders from breakout traders. This sudden influx of buying pressure creates the liquidity needed for smart money to execute large sell positions. With this significant influx of buy orders, smart money seizes the opportunity to execute their large sell orders. By doing so, they induce numerous buy orders into the market, which allows them to sell a large volume without causing a significant initial price drop. Once these sell orders are executed, the price enters the markdown phase, pushing downward. This scenario illustrates how smart money capitalizes on buy-side liquidity. They trigger buy stop orders and stop losses to generate the necessary liquidity for their large sell orders, then use this liquidity to move the market in their favor. A similar concept can be applied to sell-side liquidity, where smart money triggers sell stop orders and stop losses below support levels to generate liquidity for their large buy orders. Now, I'm going to explain one of the most important concepts every trader must understand, because it lies at the very core of market structure and liquidity. If you're new to market structure, we strongly recommend watching our market structure video here on the channel before continuing. So, let's take a look at how liquidity builds and shifts within a bullish market structure. In this diagram, each step illustrates how price reacts as liquidity is created, taken, and redistributed. Number 1. From swing low to swing high. We start with a move from a swing low up to a swing high. This forms the external bullish structure. The swing high becomes our key reference point, the level we'll be watching throughout the move. Number 2. Internal corrective structure. Inside this larger bullish leg, price starts to correct, forming a downward channel. The upper line of this channel gathers buy-side liquidity just above the internal highs, and the lower line builds up sell-side liquidity below the internal lows. Within this correction, we already have two zones where liquidity is concentrated. Number 3. Double bottom inside the internal structure. At the lower edge of the channel, price creates a double bottom. This is a key area where buyers have their stop losses and sellers find liquidity, a sign that the market is preparing to trap one side before moving in the opposite direction. Number 4. Breakout of the bearish channel without breaking the swing high. After forming that double bottom, price breaks to the upside, crossing the channel's upper line. This breakout captures internal buy-side liquidity, but notice, it still doesn't break the main swing high. It's a short-term move inside the larger structure. Number 5. Double top, still inside the internal structure. Price reaches the region of the swing high but stops right there, forming a double top. This creates another zone of buy-side liquidity above the equal highs, fuel for a future move. Number 6. Pull back to sweep liquidity below the double bottom. From the double top, price retraces downward again. This movement clears sell-side liquidity, taking out stops below the channel and under the previous double bottom. It also traps those who bought the earlier breakout, cleaning the market before the real move begins. Number 7. Bullish reversal and break of structure. After collecting liquidity from the bottom, price reverses upward with strength. This time, it breaks through both the double top and the swing high. That breakout confirms a break of structure in favor of the broader bullish trend. It's often explosive because buy stops from short sellers are triggered, along with new buy orders from breakout traders. Finally, confirmation of the higher high. With this breakout, a new higher high is formed. The external bullish structure is now confirmed, and the internal redistribution phase is complete. Now, with this visual and theoretical understanding in place, let's move to practical identification using candlestick patterns and chart scenarios. We've already discussed how equal highs and equal lows serve as buy-side and sell-side liquidity. Next, we'll focus on swing points as potential liquidity areas. From a candlestick perspective, a candlestick swing low occurs within a 3-candle sequence and represents the lowest low point situated between 2 higher low points in the adjacent candles. So, in this 3-candle sequence, we have a low point with a higher low to its immediate left and another higher low to its immediate right, making this point the proper swing low. Similarly, a candlestick swing high occurs within a 3-candle sequence and represents the highest high point situated between 2 lower high points in the adjacent candles. So what's the theory behind identifying these areas? If someone takes a long position, in this case the first scenario on the green candle area, they are likely to place their stop loss at the recent swing low. Likewise, if they open a short position, in this case, the second scenario on the red candle area, they are likely to place their stop loss at the recent swing high. With this understanding, the resting sell stop orders located below the swing low are referred to as sell-side liquidity. The resting buy stop orders accumulated above the swing high are called buy-side liquidity. It's crucial to identify these zones in our market structure mapping because smart money is always looking to push the price below or above these areas to activate their pending orders in the market. Understanding these dynamics can help traders anticipate potential price movements and make informed trading decisions. By recognizing these patterns and liquidity zones, you can gain a strategic edge in the market, positioning your orders more effectively and improving your chances of success. When you understand where buy-side and sell-side liquidity sit, the market stops looking random. Every breakout and reversal becomes a movement toward liquidity. And once you can see that clearly, you begin trading with structure instead of emotion. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.